after the 1 even. Always a bit local after the 1. Always a bit local after the 1. Always under 1. 9 half, full half. 9 half, full half.
Welcome to Day Trading, the course. I'm Gene Steele, and I will be your guide through this electronic world of stock trading. I will attempt over the next few hours to give you enough information to begin your journey on this sometimes perilous course of day trading. We will begin with the basics of the stock markets. There are, of course, several markets. Then we will discuss perhaps the most important topic, the psychology of trading, with two mental health professionals. Next, equipment and data feeds, then money management, and finally trading techniques. Today you're beginning an exciting adventure in education. For some it will change your life, and others will become knowledgeable about trading stocks. On May 17, 1792, 24 brokers met at Corey's Hotel in New York. They entered into agreements to trade stocks. From that meeting, the New York Stock Exchange was formed. Today, the New York Exchange, a nonprofit organization, handles the trading of millions of shares a day. These trades are handled on the floor of the exchange by a specialist for each stock. The specialist is responsible for the smooth order flow of shares. That means he matches buy and sell orders in a fashion that allows the price to move in an orderly manner. When there are no buyers for sellers or sellers for buyers on his stock, he must participate as a buyer or seller, taking that side of the market that is needed to guarantee the orderly progression of the share price. When he is not a participant, he is paid a small fee for matching the orders between buyers and sellers. And because of the large volume of shares, he is very well paid for this service. Check nyse.com for more information on the New York Exchange. There you will find price quotes, a view of the exchange, an explanation of how orders are placed, and other educational materials. You can also check some of the other stock exchanges on the net. There is the third most active Pacific Exchange at pacificex.com, the Cincinnati Exchange located in Chicago at cincinnatistock.com, the Chicago Exchange at chicagostockex.com, the Philadelphia Stock Exchange at phlx.com, and naturally the NASDAQ at nasdaq.com. The pre-internet or older method of placing an order was very expensive and slow. Although in comparison to what is available today, it is still possible to place a very slow and expensive order through a traditional brokerage. Before the internet, an investor would call his stockbroker if the broker hadn't called him first, and after a discussion on the latest rumor about the company, he would give his broker an order to buy the stock. The broker, more correctly called a registered representative, would then call the trading desk, and they would notify the trading floor broker to place the order. The floor broker would walk over to the specialist and place the order, making note of it on a hand-carried pad. Today, if you trade using one of the electronic discount brokers, rather than calling your broker, you send him an email. The email then is routed generally to another firm called a third market maker that your broker has sold his order flow to. Your broker did that because they get paid by the third market maker. He gets paid because there is a difference between what you are paying for the stock and what the broker is paying for the stock. The selling broker-dealer may be selling it out of his inventory or purchasing it at the bid or bidding price and selling it to you at a higher ask or asking price. When you ask for a quote on a stock, usually you will get two numbers. One, the bid price, that is the price that buyers are willing to pay, and the ask price, the price that sellers are willing to accept. These prices are advertised or reported as the best bid, which is the highest price buyers are willing to pay, and the lowest asked price, the price that sellers are willing to accept. The difference between these prices is referred to as the spread. Generally, if the stock is difficult to buy, the spread may be large. The spread may reflect demand or the risk taken by the seller, market makers, or specialists. We will return to these terms, but for now and throughout the course, I will refer you to various internet sites. A list of these sites is included with your materials. The next site is sec.gov, the U.S. Securities and Exchange Commission. You can refer to a glossary of terms found there, as well as investors' education and warnings about trading. This best bid and ask price reporting is referred to as Level 1, or the inside market, and generally includes the number of shares available at that price. Prices are reported in fractions. This is going to change, and prices will be reported in decimals. But for now, a little annoying math is required. Just remember that a 16th, also called a teeny, is equal to 6 cents, actually 6.25 cents, and the math becomes easier. So 4/16 equals a quarter, or 25 cents, and 8/16 equals a half, or 50 cents. A quote on Dell may be 43 bid, 43 and a teeny ask, 1,000 by 800. This reflects the price and the number of shares of the bid and offer, or the inside market. Back to our order. Once the order has been completed or filled, your broker receives an email, and then an email goes to you. During the trading day, there may be a significant price variation in a matter of a minute, so any delay in getting our order filled can be very costly. There are variations of this process, but for our purposes, the point is that it is slower than the methods we are going to discuss. However, there are two trading methods which will allow the use of an electronic discount broker. We'll look at those later. Here's a chart of Microsoft, drawn on a daily basis. The last price of the day is referred to as the close. This is a line chart, which connects the closing prices. We also can see here the difference between a buy and hold method and a trading method. Buy and hold is for investors. Investors and traders have the same objective, to make money on the value of the stock. The method is different. In day trading, we never hold an overnight position. That would be a sign of a bad trade. So when we rest our heads on our pillows, we don't have to worry about what might happen to affect the stock market while we're dreaming. Any increase or decrease in the value of the stock is not ours. Investors generally assume that the value of their stock will increase. A fundamental investor is one that looks at the company and evaluates its potential growth or value. If the investor feels the company is worth more than the current value of the stock, he buys the stock, anticipating that the rest of the world will discover that value and offer more for the stock. A growth investor finds a good company that he anticipates will continue to grow and profit. GE, the only remaining original Dow index company, is an example. A technical investor is one that believes history repeats itself and that repeating patterns can be successfully traded. These patterns are reflected on charts. Before we begin our discussion on charts, let's first discuss the most important and often neglected part of trading, trader psychology. Actually, we are not trading stocks. We are trading the psychology of the buyers and sellers, or supply and demand. With me today are two mental health professionals, Arlene and Erwin Isaacs. They have a group for traders to help them resolve their psychological trading problems. Arlene and Erwin, welcome to Day Trading the Course. I've asked you to come today so that we can examine together the problems that day traders have in being successful in what they do. Now, I'm not an emotional person by nature, but a lot of people are, and they haven't learned to capture and manage their emotions, particularly in trading. Now, Arlene, I know that your father is a commodity trader. Is that how you became interested in this field?
Yes, I've watched my father for many years trade commodities, and I see the emotions that he goes through, both his highs and his lows, and I found it very interesting. And when I began to study psychology, I understood what was going on.
Erwin, could you tell me something about day trading and the emotional effects and the problems that people have?
Sure. You know, it's not only true with day trading, but with everything we do. However, in day trading, the effect of emotions can be even more profound, because in whatever we do, there's a background program running in our unconscious mind that's connected to our emotional self. And within your emotional self or my emotional self. There's a whole well of feelings, emotions, beliefs, expectations about situations, and even the ways in which we value ourselves in connection with what we're doing. And this all has a direct impact on the way we'll behave when we're doing day trading.
Well, one of the major things we always hear about in day trading or any kind of trading is fear and greed. How do those things work in the trader?
Fear narrows your focus, paralyzes you, and causes you to make errors in judgment, because what you think about the most is what will happen. And when you're thinking about the frightening event connected with your fear, that's more likely to occur.
And how does greed play into this?
Well, greed has to do with a belief that many people carry from early childhood. It's the feeling of never having had enough, not having enough now, and the sense that you'll not have enough in the future as well. In fact, people who are possessed with greed, no matter what they have, they're never satisfied.
So applying that to trading, if I'm in a trade and I'm making money, I don't want to stop making money, and I want to keep trading, even though the trade may start going against me. That might keep me in the trade longer than I should be.
That's true, but what's also true is you're going to stay in some trades beyond the framework that you set up in your plan, and they're going to go well. That's going to reinforce the bad behavior. So what you want to do is give yourself a discipline and say, I have a plan, I have a structure, and I'm going to operate within it. If I'm planning to make an eighth or a quarter or a half, as soon as I'm at that point, I'm out. Even if it goes up another 3 points after that, that's okay. You haven't lost anything, you haven't done anything bad, you followed your structure, you followed your plan, and you've done the right thing.
Why is it that so many people have trouble with this and they don't seem to recognize it? Let me give you an example. I know a fellow who had a lot of money for a while, and then he started trading. He lost $75,000. He was a student in my class after he lost the money. And I said to him, after you lost $10,000, did it occur to you that maybe this wasn't for you? And how about after you lost 25? Did somebody, tap you on the shoulder and say, maybe this is not what I should be doing, or maybe I need some help, or something's gone wrong, or 50,000? I just don't understand why people, and I don't understand it, why people continue to trade, continue to lose money, and are oblivious to the fact that they're losing money, and it doesn't occur to them that they need to have training, or they need to see somebody about what they're doing. Sometimes I analogize this to being a gambler, and you know how it's addictive. Now, trading is a great deal of fun, but you can't let the fun, overrun your experience. Mm-hmm. So you have to, as you say, and the key, of course, is having a plan and sticking to it. But there's so many failures because people refuse to do what they know they should do intellectually, and you are the guys that help them get out of that problem and recognize their emotions. I don't understand why they have that problem to begin with.
It's human behavior that if you get something positive in return, you're going to do it again. Even if you only get it one time. When you mention gambler, that's exactly what it is. If you go and put money into a slot machine, you can get back 3 or 4 quarters and then lose a whole bunch, but you still feel good about the fact that you got the 3 or 4 quarters back, and you'll keep trying to get even more back because your expectation is that, well, I got those back, I'm going to get more. And it's the same thing with trading. Well, I did well on some of these trades. Even though I did terrible on most of them, I did well on some of them. So therefore, that means I can do really well. And I will keep doing it even though I'm losing money, because there's a chance that I might make some money.
That reminds me, when people talk about their trades, they never tell you about how much they lost. They only tell you about how much they made, or they had a good day, or something like that. I mean, the really honest traders would say, today I lost X number of dollars instead of I made X number of dollars yesterday, because today was a bad day, and they don't want to talk about that. That seems like it has something to do with self-esteem. Does self-esteem play a role in this?
Absolutely. Our worth is based on what we have, what material things we have. And unfortunately, that's what people do. If I have more things, therefore I must be worth more. And that's, as we know, not necessarily true. I mean, there are lots of things that we have in our life, like health and friendship and relationships, that are very important. But people don't focus on that. They focus on the material things that they can hold on to, and that's what they're worth. And it's exactly like this. Their self-esteem is connected to making that money, doing well.
And the sense of worth that a person has doesn't just appear out of nowhere. It grows from early infancy all the way through a lifetime of experience. Parents don't realize when they're raising children that they're giving them certain negative feedback and information about themselves that these children are going to carry with them into adulthood. And these thoughts and these beliefs stay inside the person in their unconscious emotional self and influence the adult person's behavior.
I think I've seen an example of that, and it really surprised me. I also believe that trading is the experience that will get you to know more about yourself, because you go through these emotions and they're so rapid, and if you're not in control, they can really take an effect on you. But I was training a trader for a year, and after a year, and she was doing very well, she was making a 500% return on paper and with simulated trading, and a year of training. And after that, the first day of her first real trade, she just forgot everything. She lost an eighth and she quit. And so what she had said earlier when we had discussed things about trading was, well, if you had been raised the way that I had been raised, and I was surprised, this is an adult, a middle-aged adult really, talking about and relating back to childhood and how she was raised when she's doing trading. And so I'm thinking that this must be a big part of the problems that people have in trading.
That's true, because in many aspects of life, especially in trading, we will find that intelligent, educated people will do very foolish or even stupid things that are absolutely inconsistent with the level of their intelligence and their education. And we wonder why. The average person will make excuses for it and say, well, this was the reason or that was the reason. But never will most people who are not enlightened about what's inside themselves ever acknowledge it was an emotional impulse. You see, to trade, you have to have discipline, self-discipline. Not discipline imposed from somebody outside or from a boss or a job, but that you set your structure for yourself and you make a commitment to yourself to operate within this structure. That's your discipline. And then you violate your own rules. And within yourself, you've now committed the same error that we see so often in society, with people making mistakes that are inconsistent with their education, with their level of intelligence, and in this instance with trading, even inconsistent with their own structure that they set up and designed to be successful traders.
That reminds me, I had an architect come to me and he wanted to learn about trading. It didn't take very long where I'm listening to him and he's telling me not about trading or his interest in trading, but what he's going to do with the extra money that he's going to make. And so I said to him, you're not interested in trading, you're interested in how you're going to spend your extra income. And that's not consistent with what you need to be a trader. He's already spending money that he hasn't made in a field that he knows nothing about. Mm-hmm. And I see so many people going into trading, they don't take any classes, they have no courses, they read no books, they just show up sometimes at a brokerage that has day trading, and they put them in front of a computer and they let them spend their own money, and they can't tell them what to do because then they'll be sued because they told them, well, I did what you told me and now I lost money, so I'm going to sue you. So there is no training that way. And but these are intelligent people, as you say. These are well educated. They could be doctors, lawyers, architects, anybody, and yet they behave in a fashion. It might have taken them years to reach their professions through study and work, and in 10 minutes they think they're going to be successful as a trader, trading against the best people in the world. I just don't get it again.
So they're not going into it for the right reasons. They're going into it because they see dollar signs at the end of the rainbow. And our belief is that when you do something, you do it because you love it, because you really enjoy doing it. Day traders need to go into this because they enjoy the excitement of trading. They enjoy the whole field, not necessarily because they're going to get the big house or the big car or something at the end of the rainbow. They're doing it because they enjoy that rush, and that's what they get, is a rush.
That's one common thing I know about successful traders. They would rather be traders than anything else.
Right.
They love it. In fact, I was just driving the other day and I saw a fellow with a sticker on the back of his car. It said, Wall Street Day Trader. And I pulled alongside of him at the light and he just said, I said, do you trade? He says, yes. And he says, it's a wonderful profession, isn't it? And so that reflects, you know, what I'm saying about that.
It's interesting that that man referred to it as a profession, not a hobby.
Right.
And a lot of people look at it the wrong way, because I think to really apply yourself as a day trader, you need to make that commitment to say, this is my profession, this is what I do. It's not a job, it's a profession. And it has a structure, it has a design. I have, in my own day trading, I have a specific plan. It might be different from your plan or somebody else's plan, but it's my plan. And it doesn't just come out of thin air, it came out of my intelligent understanding about what I want to do. And then that person needs to set up a time schedule, operate within it. He's not going to, if he says, I'm going to start at 9 o'clock in the morning or 10 o'clock in the morning, he can't hang around until noon and then get started because he's already violated his structure.
Every profession takes education. I don't know any profession that you haven't had to have some kind of training or some kind of education. And it's the same thing with day trading. You need to be educated. You can't just do it. You need to learn by your mistakes. You need to learn by the things that you've done, and you need to have an education, and you need to get people such as yourself to teach us how to trade more effectively from your mistakes.
And part of the education people get to be successful day traders needs to be an education about how you function emotionally and how that emotional functioning inside of you interacts with and influences your behavior on the outside. This is something that most people do not have in their conscious awareness. This is the contributing factor to most of the emotional relationship and family problems that people have in their life. And it also is a contributing factor to the problems that day traders have when they approach day trading with a good plan and then they're not successful.
How important is it to have, if you've got a life partner or a friend, or to have the support of that person with what you're doing?
That's crucial, absolutely crucial. And whatever education you have about yourself and about what you're doing should be shared. Even if your partner is not going to actively trade, your partner should know exactly what you're doing, how you're doing it, and why you're doing it. And even if your partner says, well, I'm not really interested in that, there should be a way to share it so that you can feel that your partner's in the day trading just as your partner's in other aspects of life.
I don't know, I've seen this commercial where the older gentleman and his wife are out for a walk, and he explains to her that he invested the money and he's lost it all, and this is the first time she's heard about that.
Mm-hmm.
I guess that's not something you want to do as a day trader.
Well, in any profession, that's not what you want to do. You need to have support by the people that you love. And if you're coming home in a bad mood, the person that you're coming home to has to know that it's not necessarily because of what they've done, but because you've had a bad day. And so that they can support you and help you and give you the energy that you need to go on to the next day.
So I'm sitting in front of the computer, I'm a day trader, and maybe things aren't going well. What sort of warning signs are there that maybe the reason they're not going well is that I'm having some emotional overrun where I'm not following my system, perhaps?
Well, I guess the first sign would be to stop, take a look, go back and analyze the trades you've done so far that day, and see if any of these trades have been done outside the guidelines that you set before you did them. And if you find that even 10% are in that category, it's time to stop, take stock of yourself and say, you know, what's going on here? When I violate my own rules, there's some reason for it, and I want to understand the reason so that I will go back to my day trading and stop violating my rules. I want to follow my rules, and I want to experience the success that comes from that. And also, you know, in terms of success, you can have a losing trade. You could define it, okay, I lost on that trade, and that's okay. You could have a losing day. And you should be able to stand up from your computer and from your desk and say, well, I lost money today, but that's fine, because this is just part of what I do. And you could have even 2 losing days in a row, and it's still okay, because you see, you must take a bigger look at the whole picture and a broader look at the whole picture of what you're doing, and understand that you have a plan, you're staying within your plan, you're not letting this perception of a loss affect your understanding about your sense of value of yourself, and that you're going to continue working within your structure knowing that it's going to bring you success.
Let me give you another example. I know a fellow, he lost $500,000 in a year. The money came to him easily as a result of a tragedy. And I met him after he had lost that money at a seminar a friend and I attended. And when I talked to him later, he said, I'm never going to trade again. I'm giving this up. And he was quite discouraged, and rightly so, from what he had done. But he was trading options. He didn't know an option from a chicken at the time. And that's really, I mean, to lose that kind of money. So anyway, I thought, well, I'll never see this guy again. It wasn't about 3-4 months ago when I ran into him. I was at another seminar, and there he's sitting there. And he walked in, my friend and I were there, and you could have knocked me over with a feather, because I'm thinking, what is this guy doing here? So we had coffee afterwards, and I said, what are you doing here? And he said, well, I like this guy's ideas. And so I said, when I saw you last time, you said you were never going to trade again. And he said, well, I could make money in real estate, but I lost the money in the stock market, and I'm going to get it back. Now, what is that about?
That's revenge trading. It's when you're feeling that the market did something to you, and you're perceiving it as your enemy, and you're going to go back and win your money back. It's
The market took my money, therefore I have to get it back from the market.
It's so strange, because the strange thing is, then the conversation went on, he had over $1 million in property, and he wanted to know if he put up the $1 million, he could use that money to trade with. And I just looked at him, I said, you know, you need help. You're doing the wrong thing, and you don't know what you're doing, number one. Well, and once again, I had a trade, I made some money yesterday or something like that,
Right.
only telling you about the positive things, you know. But meanwhile, this guy has no chance, I mean, at all. And there are people like that, but there are just too many. And I want to get the word out that there are too many. And you have to recognize these emotional stresses so that you can do what? You can adjust yourself, stop trading at the time. You know, how do you recognize? We discussed that maybe you're not following your rules. Maybe you're so involved you don't even recognize you're not following your rules.
Well, you need to, in your structure, set up certain points in the day when you'll stop and do an analysis to see if you're following your rules. And I think that would be an important part of this course that you're teaching people, to tell them to do that. Because in that way, even without having any other warning signs, they could discover that they're making the error of violating their own self-discipline, and therefore they can make a correction.
Just in life, sometimes you have to stop and reevaluate where you're going and what you're doing and who you're with. And it's the same thing with this. You get so involved in it, and it just consumes you so much that you can't see the forest for the trees. And sometimes you just need to stop, step back, take a look what you're doing, stop trading altogether for maybe a day, a week, however long it takes for you to reevaluate what's going on so that you can feel good about what you're doing again.
I always begin my classes at the college on trading with close your eyes, take a deep breath, relax, and people think, what is this about? Then I tell them, when you're sitting in front of your computer, there's two things you should know. First, there are no new decisions to be made. You're sitting down with a plan, and you have to trade your plan. So when you see something happen, you don't have to come up with a new idea about how to react to it. And the other thing is that peace and serenity you're feeling now after closing your eyes and taking those deep breaths, that's the feeling you should have while you're trading.
You know, Gene, there are people who look at us, they know we're psychotherapists, and they think that we only deal with individuals who are crazy or who have serious mental problems. And that's not a correct perception. Many of the people who come to see us, in fact, most of the people who come to see us, are perfectly normal people who are living reasonably good lives. They come to see us because they want to have more insight into how their emotions are affecting what's going on in their life. And some of these people are clients who come to see us once a month or once every couple of months because they realize the value of keeping in touch with their inner self, with their emotional flow that's going on inside of them. And this is very important for day traders. You must keep in touch with what's going on inside of you. Even though you're a day trader, that's not the only thing in your life. You have you possibly have a significant other. You might have a family around you. You might have children or sisters or brothers or an elderly parent. There could be all kinds of things going on around you in your life that have an influence on your thinking process and on your emotions. And as a result, it's very important to periodically stop and take stock. Some people can do this on their own, just by taking a deep breath and looking inside themselves. Others find it very helpful to see a therapist or a counselor and explore periodically where they are within themselves. And some people even participate in group counseling sessions specifically for day traders, and we've set up such groups to help day traders so that they can relate to one another while they're learning about these issues.
There's so few people that even know that there are mental health professionals out there that work just with day traders and traders that it's a revelation to them. And, well, there's a reluctance also. You said, you've sort of explained that people deal with their problems. They're ordinary people. They're regular. They're not, you know, off-the-wall kind of people. Mm-hmm. And so the people that come to you that are traders, they would be ordinary people that are working out these problems in their trading life and not necessarily anything else, although it may relate to something else.
Well, some people don't even experience problems. They just say, I'd like to know how to be even more successful than I have been.
Well, there are successful traders that get help too.
That's
to
right.
be more successful.
Exactly.
Yeah. And also, I think that hypnosis is sometimes used for this as well as just discussions.
Yes, hypnotherapy is an aspect of, is one of the modes of therapy that can be used, and it depends on the individual and the specific needs that are presented.
You can't hypnotize somebody, you're going to be a great trader, you're going to be a great trader. That doesn't...
No, but
We can't hypnotize anybody to do anything that they don't really want to do.
But even if they want to do it, you know, I want to be a great trader, I want to be a great trader. So,
Well, but people can say that, they verbalize that, but there's something inside of them that's preventing them from doing that. And that's what we help them do. We help them get in touch with that piece of them inside of them that's saying that they can't or they won't or they're not worthy of doing it.
you know what I found? Some people are afraid of success.
Yes.
And in working with one individual, a female, she was afraid that she was going to be so successful that she would lose her husband.
That's right.
Because the roles would be changed, and now she's the money earner making $1 million a year, and the husband is still stuck at $100,000.
that's part of it. But you might find, if you're looking through back in the family history of people who fear success, you might find that they learned from observing around them as they were growing up that the person who was perceived as the loser or the weakling or the one that was plowed under, that one got a lot of sympathy and attention and love. And it might be hard to believe that an intelligent person on a conscious level would say, well, I need to be in a needy underdog position in order to get loved, but unconsciously, on a deep unconscious level in the emotional self, that belief could very well be there. And that very often is the explanation for why a person will be self-defeating, avoiding success. Because there's a fear that once I succeed, I will no longer be loved, appreciated, and cared for.
We've even heard people say that all the successful people I know have all these tragedies in their life. And so therefore, in order for me to have my life okay, maybe I shouldn't be too successful. Maybe I should just accept what I have and not try to have more, because I don't want to have those tragedies in my life. So everybody relates differently to success, to money, to wealth, to feeling good about themselves.
I recall a study was done that showed that most people who trade are trading for reasons other than trading. In other words, I'm trading to impress my mother-in-law who never liked me, and I'm trading for this or that. And it's just not an issue to trade to be a good trader and to enjoy every trade and enjoy, hey, I got that right. I stuck with my discipline. I made money today, but that's coincidental, the fact that I did a good job trading. It's interesting that most people from that study shows that they're not motivated, that's not their motivation. It's the basic human things that you're talking about.
That's right. In fact, in connection with that is this strange belief that some people have that just by wishing real hard that they could affect the movement of the market so that it'll do what they need it to do. And that's one of the realities that traders must learn, that the market will do what it's going to do and you have no control over it. You only have control over what you are doing.
Erwin, we've talked about several things. What about what a trader has to learn? For example, executions.
Well, you know, Gene, there's an optimum moment for getting into any trade, and there's an optimum moment for going out of that trade. And the only factor that's going to keep a trader from executing at the right moment, either in or out, is fear. As we spoke about earlier, fear can be a paralyzing influence. The fear of all these emotional consequences that can occur. So the trader who is free of his emotional interference with his behavior is the one who's going to execute the trade at the optimum moment to go in and the optimum moment to get out.
Would that be objectivity?
Yes, because you see, you're being objective about it. It's just something to do. It's part of your job that you've given yourself, rather than a definition of who you are and what your value is as a human being.
What about learning what you need to be a day trader, recognizing that? Is that important?
No matter what you do in life, and particularly day trading, you need to get educated about the subject. You need to learn the techniques, and you need to practice the application before you actually go into the activity. And so a proper education is certainly something I would highly recommend for anyone planning to go into day trading. And included with that education with regard to theory, techniques, and practice, I would strongly suggest some education for each person about who you are in your emotional self.
Do you think that anyone can learn to day trade?
I believe that any person can learn to day trade. If a person says, this is what I would like to do, and has a reasonable degree of intelligence, that person can learn the activity and can be successful.
And there has to be a commitment. They have to be committed to doing this. They have to decide why they want to do it, what they want to get out of it, and they need to be consistent when they're doing it. They can't fluctuate. Well, maybe I'll do this today and maybe I'll do that tomorrow. There has to be consistency in what they're doing.
So it's handled in a business-like, serious manner.
Absolutely.
Okay. Well, thank you very much for being on Day Trading the Course.
Thank you, Gene. We enjoyed being with you. Thank you for asking us.
The first question you may have is, where am I going to do this day trading? There are a few choices, but whatever the choice, you must choose a place that you will not be disturbed while you're trading. For example, if you choose to do your trading at home, you cannot have interruptions by phone calls or people running in and out, or if you're watching your children, because this type of trading takes a great deal of concentration. Another alternative that professionals sometimes use is to rent a separate location, an office or an apartment, and set their programs and their equipment up there and trade. Another choice that's also popular is to go to a trading room. Trading rooms, there's a conflict as to whether or not those are really good for beginning traders. The argument is that in trading rooms you're surrounded by other traders, perhaps people more experienced, and that they're going to help you learn to trade. Basically, this is a distraction. In trading rooms, and I've been in several, sometimes you have several people watching various stocks. And one of the techniques they use is when a stock starts to move, they'll call out the name of the stock. Microsoft is moving. Dell is moving. Well, to a new trader, by the time he gets everything done, that move might well be over. He's entering late in the trade, and it's a negative. You have to decide, based on your personality, what the best place to trade would be. Also, in dealing with trading rooms, remember, their focus is to get you to trade. Also, you've got to be very cautious of trading rooms that offer to lend you money, or trading rooms that give you 10-to-1 equity, or say that they trade with their money but you have to pay all the losses, which allows you a great deal of flexibility in terms of what you're trading, the amounts you're trading. You might be trading millions of dollars, and one mistake will wipe you out. Common sense is very important when dealing with trading rooms. Some will charge you a fee to sit in the room and use their equipment because you don't have to buy that equipment, you're using theirs. And they'll give you a credit for the amount of commissions or trades that you use, and you may not owe them anything. The key is, wherever you trade, you must be comfortable and may not be disturbed while trading. It could assist you to be in a trading room if you have that type of personality. Some traders I know have to be on the phone with at least one other person. And other traders like to lock themselves away in a quiet room and focus just on trading. It depends completely on your personality. Now the next question is, if you're going to trade somewhere where you have to supply the equipment, what type of equipment do you need for trading? Naturally, you'll need a computer, and you'll need a telephone, a stopwatch, a regular television set with a data feed. Let's talk about each of these items. The telephone is used as a backup to reach the trading desk in case you have a power failure. You might even have a mobile phone in addition to that. If you're in a big trade and you lose connections with the internet, which can happen, then you'll want to be able to get to the trading desk as quickly as possible. Next, you'll need a stopwatch. I have a general rule that if the trade doesn't move in my favor in 2 minutes, I'm out of the trade. I've made a mistake. So in starting the trade, I'll start the stopwatch, and then I'll know that within 2 minutes I have to be out of that trade. There are different methods of managing your trades, and this is an additional one based on time. As far as a computer goes, a minimum of a 500 megahertz computer with maximum RAM is what I would say is recommended. I've tried a 1,000 megahertz computer, and the difference is not significant to me. We're very fortunate today to have Trikinetic equipment with us. They make computers and systems and monitors just for traders. They're located in Austin, Texas. You can see these monitors, which cost about $15,000 total, are certainly something that any trader would love to have. They're easy on the eye, and the space of 18-inch monitors allows you to build your screens and put a lot more information on than something smaller. You'll also need to have generally CNBC if it's in your area, or Bloomberg television running all the time. The reason is that when something is mentioned on CNBC, it generally creates a reaction in the stock. It might be a small reaction, good news or bad news, and we'll talk about trading techniques, but you'll want to have it on in your location. In every trading room and almost every place now in the country, CNBC is on. The difference between CNBC and Bloomberg, in my opinion, is sort of the difference between the Wall Street Journal and Investors Business Daily. Investors Business Daily is technically oriented, as Bloomberg tends to be, with more charts talking about money flow and things of that nature, because they're a data provider as well. You know about the Bloomberg terminals. So you'll want to have the television running. You'll want to have your backup phone system with auto dial set to get to your broker You might also want to get to your software suppliers, technical support in case there's a problem. You'll want to have a stopwatch ready to start timing your trades on your entries, your exits, and you'll also want to have good equipment. Now, you won't need 4 monitors as we have here. However, because I develop systems and I want to demonstrate some things today, we'll have 4. You definitely will need at least 2. With the new Windows 98 and other systems, you'll be able to run 2 monitors off 1 computer. That way you can have a much bigger computer and more information available to you. Charts and time and sales and those things running at the same time that you'll want to look at. You'll also need a data source, and it's important to have very fast data. There's a saying in trading, there's the quick and the dead. So the choices depend on the area that you're in. T1 lines are very expensive but very fast, and probably too expensive for the average trader at home. But with SDSL and ADSL and a system that is always on, we're now getting into the type of data that we need and the type of supply of information. A great deal of information comes across the net in terms of prices and has to be handled rapidly by your computer. And you cannot have slow data. The interesting thing about it is that the data source depends more on you asking for the data through your data source than the way it comes to you. Some of the data sources, the internet and so forth, come to you all at the same speed, but because you ask for it slowly, based on the method that you're using to ask for it, whether it's through a modem or SDSL or so forth, you're not getting it as quickly. So you want to get the data at least as fast as everybody else does around the country. You can use a satellite, but the problem with the satellite is that when there's a heavy rainstorm, you're liable to get interference. Just the other day, a friend called and said, "That indicator cost me $2,000. And I looked at the chart and I said, "Well, you should have been out." "No, it kept me in." I said, "Let's look at the prices." When we saw the prices, we noted that there was a blank space in the price that would have taken them out of the trade. I said, "Was it raining heavily?" "Oh yeah, we had a big thunderstorm." Well, I said, what happened was you didn't get the data because the satellite feed didn't work very well during a thunderstorm. It couldn't see the satellite. In addition to that, FM radio is available as a source, but almost everybody is going to the internet. FM radio is being phased out, and a lot of these other things are being phased out in reference to the internet, and new things are being developed as well. Make sure that whatever data source you have, that it's reliable. I would not recommend, if you can avoid it, a modem with an IP, because what happens is a lot of the suppliers of this access to the internet, if you don't have some action on the screen, will cut you off. Now you'll have no data and you have to start and reconnect again. Best suggestion right now is probably SDSL or ADSL or cable modems as a third lower choice if it's available in your area. Also, keep in mind that the data must work with your software program. The type of data, the data source, who supplies the data may not work with the kind of program that you're using. So you have to have something that's compatible. So first figure out what kind of data is available, fast data, and then check to see if the software that you want to use will work with the data source that you're using. Let's talk about money management. This is the second most important topic after trader psychology. Let me give you the rules of money management. The first 3 rules are: don't lose money, don't lose money, don't lose money. The money that you use to begin your trading career should be risk capital. Risk capital is defined as that amount of money that would not change your life if you lost it. Also, if you have the right mental attitude, rather than if I lose this trade, I won't be able to get this or do that or make my car payment. That emotional impact on you will prevent you from having the appropriate mental discipline in order to trade effectively. There are other sources of money other than your own income. If you can prove through your trading, your simulated trading, you might be able to have people sponsor you, but you must check with the Securities and Exchange Commission and other regulatory bodies if you're using other people's money to trade. You might have to be licensed or have other liabilities, so you wouldn't want to do that without checking with an attorney who is familiar with this area of managing other people's money. You also could be employed by a company that will teach you to trade. We'll get to that in the ECN section when we look at Ready and Spira Leads. They have a summer program for traders. Money management, more than the 3 rules of not losing money, means that how you control your losses, much more importantly than how you control your stops, determines your success. Studies done by statewide agencies on day traders showed the difference between the professional and the amateur was the ability to control the losses. Losses may be controlled by stops. However, in the NASDAQ market, our stops are ourselves. I used to say as a boater, my insurance was my ability as a captain. So you must have a firm disciplinary rule. What happens in terms of managing your losses, which is really the definition of money management, is you look at a trade, and as the trade is progressing, it's down to your limit that you've set, maybe a 1/16th, an 1/8, a quarter, and greater size generally means that you're going to have a greater amount of spread that you're willing to lose if you're more experienced. But I would say that the average beginning trader should look at about a 1/16th, no more than an 1/8 of a loss per trade. There's also a formula generally given as to 1% of the amount that you've invested. So that if you had a $10,000 risk, you'd want to have a $100 loss. And that would be your amount, that the most you would lose, and you would be out of that trade. You can see that by being out of the trade with a $10,000 capital, it would take some time losing $100 for you to be totally broke. However, I would also say that if you're not getting it by the time you've lost 40% of your risk capital, that perhaps you ought to rethink what you're doing. Now, in terms of trading, keep in mind that you're able to get twice as much based on the type of account you have being a margined account, so that if you have only $10,000 to trade with of your own money, you will be allowed to trade $20,000. Reg T, as it's called, presently allows 2 to 1. And as long as you're a winner, you have nothing to lose. However, if the maximum amount of money that you can lose is $10,000, then you're at risk when you're using that margined money of losing $20,000. A lot of big winners in the up market were very surprised to receive margin calls because they had extended themselves well beyond their capabilities to pay and resulted in a lot of losses and a lot of problems. So if you use margin, be aware that you're risking more than you have. Some brokerage firms allow you 10 to 1 by manipulating regulations or requiring that you be a licensed or registered person. Also, they also require that you pay your losses. So you don't want to get involved in using margined money when you're learning to trade, because those losses are real losses. There's no such thing as a paper loss. If I can go to the bank or I can call a broker when I have a profit and get that money, that's my money. A paper loss, oh, I lost it on paper, I was dealing with their money. There is no their money. This is a serious business and requires that you view it in that manner. The first rule in money management is to adjust where you're going to get out of your trades. Now, there are books written on money management with formulas that will allow you to determine the exact amount to trade. But for our purposes and for low amounts of capital, and you certainly wouldn't want to start, no matter how many millions you have, to learn this business by putting all your money on one stock in one trade, because that would be the definition of foolishness. So you might want to start with enough money that you can trade stocks that are trading at a value that you can afford. The average stock that is tradable is $40 or more. You might be trading stocks that are $20. In terms of share size, there's what we call scaling in and scaling out of trades. This is more appropriate for larger volumes of shares, and money managers often do this. They might set first 25,000 shares, then another 25,000 if the trade's going their way, and another 25,000. But if you're trading 100 shares or 300 shares, you might not want to do it at 100 at a time, because the stock you're trading may move so rapidly that you're not getting a trend, but you're getting maybe a 16th profit or 1/8 or 1/4. No software does it all. So it's often necessary to have more than one brand of software. The software might be designed for charting. It might be designed for automatic indications. It might be designed for trading. So now we're going to go through the software that is part of your bonus after course completion and see if we can get you to learn how it works and save some time. First program we're going to discuss is Metastock by Equus, the professional version. First of all, there's a blank screen. This is basically a charting program. So let's make a chart. I'm going to use a chart that I've previously used. The interesting thing about Metastock is that it gives you a choice as to the time that you want to display. In this case, we're going to display the last trading day and today. Now you can make the colors anything you want, but for the purposes of the video, we're going to use a black screen and yellow charting indications. One of the things you'll notice is that some of these lines are very long and seem to be out of proportion to the rest. That's a matter of who your data supplier is and whether the data is clean data or they just send it out as it comes from the stock market. Let's take a look at these marks on the chart, which may or may not make sense to new traders, and we'll just select them and we'll make them larger. This is called a bar chart because the shape of the price indication is in a bar. Here's one bar. Now the bar indication shows during the time period selected, whether it's a day, a month, a week, or 2 minutes as it is in this case, the opening price or the first price during that time period is shown at the bottom with the bar extended horizontally to the left. In this case, we have the low price was also the opening price. During the time period, the lowest price that the stock traveled to was indicated by the bottom of the bar. The top of the bar indicates the high, or the highest price during that time period, and the horizontal bar that extends to the right indicates the closing price, or the last price. So here we have the open, the high, the low, and the close. The bar next to it, notice that the open was in the middle of the bar. Then we have the high, and in this case, the close was where, or the last price, was where the high price was. And the low is indicated at the bottom of the bar. You can take a line and figure out from here that that price was 44.99 for the low.